Don't sit down and wait for the opportunities to come. Get up and make them. Good evening, MBA 06, MBA 07, MBA HR 01, MBA BA 01, EMBA 01, PhD 01, PhD 02, EPDA, and alumni. On behalf of Industry Interaction Cell, I, Ankit Nathani, along with Jasdeep Singh, welcome you all to Pariprekshya', the 5th annual Finance and Marketing Conclave of IIM Amritsar. I would like to invite Vaishak MS and Sumedha Malhotra from MBA 07 batch to give a short presentation about today's theme.
Thank you, Ankit. This is Sumedha and Vaishak presenting rebuilding and expanding M&A strategies. Post-COVID-19, there had been fiercer competition, broader regulatory scrutiny, which have made deals more complex. Now, even the best acquirers must revisit their M&A capabilities, reevaluate their M&A strategies, embrace alternative participative models, bring expertise into the process, know the battlefield, and be ready to move quickly. The picture in the Asia-Pacific region has been more mixed as COVID-19 has affected countries differently. China, which recovered from the pandemic earlier than other countries, has seen an acceleration in M&A activity. Some government and creditor support in other countries, such as moratorium on interest payments and a temporary ban on new insolvency filings in India, has helped suppress the number of distressed transactions. During the first 3 or 4 months after the COVID-19 pandemic spread throughout Europe, Middle East, and Africa, the level of uncertainty in the market, combined with low business optimism and confidence, was so high in the region that there was little M&A activity. However, generous government support programs, including support for employees and payroll, as well as creditor forbearance schemes, have allowed many companies to weather the storm through 2020. In the Americas and the US in particular, many companies were in survival mode in the second and early third quarters of 2020. Distressed transactions were fairly prevalent, including debt restructurings, defensive M&A transactions, such as liquidity planning and other transactions to strengthen balance sheets. This was due in large part to uncertainty about the evolution of the pandemic and uncertainty about the level of government support. The first half of 2021 saw a continuation of the growth in deal size, contributing to record global deal values in excess of $1 trillion per quarter over the past 12 months. Fresh capital inflows led by the SPACs have been an important catalyst, as has been the increase in private equity investment and corporate acquisitions, particularly those focused on technology assets. Panasonic, signing a $7.1 billion agreement in April 2021 to acquire Blue Yonder, a developer of software for managing enterprise supply chains, intended to strengthen Panasonic's portfolio and accelerate the company's shared autonomous supply chain mission. Walmart's announcement in May 2021 of its planned acquisition of MEMD, a telehealth company, intended to further Walmart's omni-channel health delivery strategy. COVID-19 has shown us how to fight the uncertainty. It's reflected in the performance of companies during the second wave. Nestlé's acquisition of Freshly in healthy meals delivery is a good example of how companies are trying to expand their business in the most diversified manner. Super apps are becoming a trend in consumer tech, with China's WeChat and Alipay setting the standard for super apps. Other businesses are catching on. From east to the west, many are eager to ride the wave. As we went through COVID-19, now the process is also fast, as quick and swift reaction was required then. Joint venture is a good strategy to enter into a market as it is risk-free and also less capital is required. The competition in the market is so high these days, it have made every deal like an auction. Private equity funds sitting on $2.8 trillion of dry powder look a lot like corporate acquirers. they're starting to hold their assets longer and use buy and build strategies. The first half of 2021 saw a continuation of the growth in deal size, contributing to record global deal values more than $1 trillion per quarter over the past 12 months. Fresh capital inflows led by SPACs have been an important catalyst, as has been the increase in private equity investment and corporate acquisitions, particularly those focused on technology assets. ESG, environmental, social, and governance factors, have made gaining in importance as companies acknowledge their role in value creation. Environmental issues are becoming business-defining concerns, and many companies will reorient their strategic direction accordingly. The global disruption triggered by COVID-19 led executives at many companies to review their portfolios during 2020 and into 2021 to reassess their strategies. This has led to a trend of corporates using M&A to acquire capabilities they don't have, often in technology, to enhance existing capabilities and reinforce that advantage. There has been an increasing acquisition activity due to supportive markets with low capital costs, rebound in sectors impacted by COVID-19, companies increasing scale and acquiring technology, recovery in cross-border M&A, abundant capital from private equity and SPACs. SPAC, Special Purpose Acquisition Company, is a shell corporation listed on stock exchange with the purpose of acquiring a private company, thus making it public without going through the traditional initial public offering process. Almost 400 SPACs bring as much as $500 billion in combined cash and leverage expressly earmarked for future deal making. Now Vishak will take forward from here.
Drivers of M&A strategies. It is said that in the most M&As, synergies are not only the key drivers too, but all the core objectives. Synergies have always been predominant motive in the acquired public documents to convince their existing and potential investors. Companies fast grew. Geely's acquisition of Volvo, Lenovo's acquisition of IBM Personal Computer Division, and Motorola Mobility. These acquisitions gives companies marketing advantages, protection advantages, finance and management advantages. Access to capital markets. Listed companies are the targeted companies in M&As. The existence of a share market has caused the cost of M&As to fall substantially. In the share market, the financial cost is relatively low, and that's a financing key is a key point of M&A. Motivation of the government. Let's take the example of our neighbor China. The state-owned enterprises still hold the most dominant position. M&A activities are not always a result of economic behavior. The government plays a very important role in the corporate strategic decision making. Other factors. Some of the other factors in M&As such as speculative activity, discovering, buying target companies in which market value is underestimated, improving reputation of the corporation and management, increasing market value, maintaining competitive advantages over comparison. During the economic global financial crisis, enterprises had faced tough competition for survival and development. To prevent being acquired by large enterprises, some companies had to buy other companies or they had to unite together with other companies in the form of group of companies. Due diligence. Due diligence is a process of verification, investigation, or audit of potential deal or investment opportunity to confirm all relevant data and financial information and to verify anything else that was brought up during M&A deal and investment process. Let's see some of the key aspects of the due diligence. Target company overview, understanding why the owners of the company are selling the business, have their efforts to sell the company before. Financials, examining historical financial statement, related financial metric with future projections. Are financial statement audited? Technology and patents, the quality of the company's technology and intellectual property. What patents does the company have? Strategic fit, how does the company fit on the buyer's organization? Will synergies will be obtained? Targeted base, the company's targeted consumer base and the sales pipeline. Who are the customers, company's top customers? Management and workforce. The company's management employs corporate structure, the current compensation structures. Legal issues, pending, threatened, settled litigations. What is the nature of any pending litigation? Information technology. What software packages are being used by the company? What are the annual IT maintenance costs? Increasing M&A complexity. Are you ready for the IT challenges? License complexity can be solved by analyzing analysis tools. Tools that analyze IT environments and perform discovery of existing assets can help integration teams create a comprehensive inventory of existing assets. Using this information, IT leaders can redeploy license in a way that makes business sense for a new company. Data integration. Data integration tools can be done by data migration tools. The global IT integration should be combine customer data from both the firm into a cleansed and concise golden record. It is impossible to do without a comprehensive view of existing data. And many organizations rely on master data management tools to locate and consolidate their critical data. Merging, it can be done through cloud resources. Typically, merged companies will standardize the physical equipment over time. But IT leaders should be prepared to respond to the performance problems, new environment, especially in the early days. Security solution. It's usually best for the new company to simply meet the higher of the two bars. As simple as that. Consulting and management services. Services from a third parties can be a crucial part of the M&A success. A trusted partner can lead or assist with the process ranging from inventory and data migration to cloud resource mapping and security assessment. What to do now? As business models change and companies revise their top-level corporate strategies, the M&A team's mandate should be updated. Among the biggest issue with evolving ecosystem and digitization. Expand the option beyond outright M&A and diverse the JV partnerships because it's less risky. Deeper connection to the business unit during the diligence process, expanding the set of external partners. As you acquire a company, you just don't acquire the company itself. You acquire the culture, the sustainability, the consumer sentiment. Track the industry landscape, how it evolves, and know how to focus very quickly when the opportunity arises. Bridging the gap. Bridging the gap can be done during using a game-based strategy. Who, when, what, why. Who? The top company, the top executive of the buyer organization, supported by the key deal team and integration team leaders. When? At the earlier possible opportunity, when it is certain that the deal will close. What? Tackle the biggest decision, issues, risks, and opportunities first. Why? Ensure timely strategic directional guidance to launch integration, align decision, and deliver results. How to do it? As scope and capability deals gain share, companies are bringing in more expertise from internal networks and partner ecosystem. Companies also need specific process to actively manage JVs, alliances, and other partnership models. This is particularly important as failed JV alliances or partnerships that have reduced the potential company's reputation within the ecosystem, damaging its ability to attract new partners down the road. Companies need to invest in the right technology to mine the gold that is data. It is essential harnessing new insight from data not only provides a better view of risk, but also a cleaner picture of deals upside potential. Future of M&A deals. Surprisingly, response indicate that more appetite for M&A activity since March 2020, when the World Health Organization declared COVID-19 as a pandemic. 60% of all the respondents have more appetite for M&A activity since March 2020. Hoping to see more future strategic acquisition in future that excites each business enthusiast that is present here. Thank you. That was our time.
Thank you, Vaishak and Sumedha, for introducing the theme of the conclave. Without further ado, I would like to steer the conclave towards the discussion on the theme by introducing today's guests. Let me first introduce the keynote speaker for today, Mrs. Praveena Kala, Independent Director, Senior Strategic Advisor, and Visiting Faculty with IICA. Mrs. Praveena Kala is currently a Senior Advisor with multinational company, Independent Director with listed companies, and Honorary Member of PhD CCI. During the financial year 2018-20, she has held position of Local Board Member of SBI, Director at Odisha State Financial Corporation and Institute of Entrepreneurial Development, Odisha. She is also a visiting faculty with IICA and University of Delhi on Markets and Finance. Mrs. Praveena has also held many leadership positions in national and international banking operations of over 3 decades in State Bank of India. She was permanent invitee to Central Board and Executive Committee of State Bank of India as ES to Chairman. Now let me introduce you all to our respected panelists. Our first panelist, Mr. Sambasivan G, Chief Financial Officer, Tata Sky Limited. Mr. Sambasivan is a postgraduate from IIM Ahmedabad, a chartered accountant, a cost accountant, and a company secretary. He has over 28 years of experience across FMCG and service sector industries, including over 15 years of experience with Vodafone at senior finance and operation positions. He has been with Tata Sky for nearly 8 years. Before joining Tata Sky, he was with the Vodafone Group in the UK as a regional financial controller for Northern Europe. Mr. Sambasivan enjoys reading eclectically and pursues his interest in playing chess, listening to audio lectures, and running the marathon in his leisure time. Our second panelist, Mr. Vikas Ralhan, Chief Financial Officer, Loconar. Mr. Vikas is a seasoned and result-oriented sector-agnostic financial leader with 18 plus years of experience across industries and stages with technology, consumer, industrial, media, and services, global and Indian startups. Mr. Ralhan is a fellow member of ICAI India, IIM Ahmedabad alumnus, and PhD holder in cyber and technology laws from Nalsar. He has hands-on experience in startup, fundraise, corporate structuring, designing, and scaling strategic and business finance. Mr. Ralhan is passionate about working closely with young entrepreneurs, setting up scalable processes, resolving workplace ambiguities, and converting them into opportunities. He is an avid traveler, reader, and enjoy long-distance cycling and running. Our third panelist, Mr. Nitin Parekh, Chief Financial Officer, Cadila Healthcare Limited. Mr. Nitin Parekh serves as the Chief Financial Officer of Cadila Healthcare Limited, having an annual turnover of more than rupees 15,000 crores and has 36 years of post-qualification experience. He joined Cadila Healthcare Limited in February 2009 and has been handling the functions of finance, legal, and information technology. Before Cadila, he worked as an executive director of Ashima Limited. Mr. Parekh is selected as India's best CFO large enterprise by Business World in August 2021. He is also the recipient of the Top 50 Finance Leaders of India 2021 award from White Page International in July 2021. He received the Glory of India Award from Indian Achievers Forum in 2021. He received the Outstanding Manager of the Year Award from the Ahmedabad Management Association in March 2021. He has served on the Board of Governor of the Institute of Chartered Financial Analytics of India, ICFAI Business School, ICFAI University, and Accountancy Board of Gujarat University. He is presently on the advisory board of Adani Institute of Industrial Management. Our fourth panelist, Mr. Venkatraman GS, Senior Vice President and Chief Financial Officer, Subex. Mr. Venkatraman GS is the Chief Financial Officer of Subex and has over 25 plus years of industry experience across all facets of finance function. He has done his BCom honors and MBA in finance. He has been instrumental in leading and completing the capital reduction of Subex, which has helped in the equity capital and balance sheet becoming leaner in line with the company's size. The steps taken to address the capital structure of Subex and strategies adopted by the company have led to significant shareholder wealth creation, where the market cap of Subex has moved from rupees 325 crore in November 2018 to a little over 2,000 crore currently. CFO India has recognized him as among the top 100 CEOs for 2021 under the Innovation in Finance category. Before his current role, he was a finance controller for Mindtree. He has deep understanding of enterprise risk management, and he also has worn the hat of being the first Chief Risk Officer for Mindtree. Our fifth panelist, Mr. Raghupati Mishra, Group Chief Financial Officer, Liberty House Group India. Mr. Raghupati Mishra is dynamic and seasoned management professional with over 2 decades of experience and expertise in various aspects of the business. He has a proven track record of turning companies to EBITDA positive, setting up new companies, and putting in systems and procedures. His forte is fundraising, debt restructuring, formulating and executing business strategies, mergers, and acquisitions. Expertise in accounting in the SAP environment, statutory compliances, corporate governance, identification and mitigation of risk, etc. He has multiple industry exposure like information technology at HCL Technologies, telecommunications at Bharti Airtel, and Systema Teleservices, and infrastructures and oil field at SL Group. He also has experience of steel and energy at Liberty House Group, including launching greenfield operations in various geographies. A people's leader inspires the team to grow as a competent professionals and give the best to the organization. Our guest will be joining us shortly. Kindly wait for a few minutes. Praveena ma'am has also joined. Good evening, ma'am. Also, Vikas sir has joined. Good evening, sir. Jasdeep, I think we can start.
Yes, Ankit, thank you. So finance is not merely about making money. It's about achieving our deep goals and protecting the fruits of our labor. It's about stewardship and therefore about achieving the good society. Good evening, ladies and gentlemen, respected keynote speaker ma'am, our esteemed guests, faculty members, and the students of Indian Institute of Management, Amritsar. I, Jasdeep, would like to welcome you all to Pariprekshya', the 5th annual Finance and Marketing Conclave of IIM Amritsar. Learning has always been a force that powers the paddle of success. And what could be a better platform for the brightest minds to come together and enrich the students with their epitome of experiences? Leadership is not about a title or designation. It's about impact, influence, and inspiration. Unfortunately, our director, sir, would not be able to join today, but we are fortunate to have another such leader to guide us, our faculty anchor, Professor Udayan Sharma. I would now request you, sir, to kindly address this august gathering.
Hello, everyone. I welcome you all to Pariprekshya'. And first of all, I would like to thank the team for organizing this enclave on financial marketing. And I would like to welcome all the esteemed guests here. So as we know that the post-pandemic world has put many restrictions on the way businesses behave, businesses have to function. And because of these, new strategies have to be emerged. Now, the theme of today's conclave is mergers and acquisitions and omnichannel business strategy. Now, time to time, we have been encountered with these concepts in the class, right? But how are these things being done at the corporate level in the real life? And who would be better at explaining it than the industry experts who are doing it right now, who are, very closely watching it. So without taking any more time, I would like to hand over the stage to our esteemed guest so that we can go ahead with the discussion. Thank you.
Thank you, sir, for sharing your kind thoughts and enlightening words. Now I would like to introduce you all to the keynote speaker for the conclave, Mrs. Praveena Kala, ma'am. Mrs. Praveena Kala is currently a senior advisor with a multinational company, independent director with listed companies, and the honorary member of PhD CCI. During the financial year 2018-20, she had held the position of local brand member of SBI, director of Odisha State Financial Corporation, and Institute of Entrepreneurship Development, Odisha. Mrs. Praveena also held many leadership positions in national and international banking operations of over 3 decades in SBI. She was the permanent invitee to Central Board and Executive Committee of State Bank of India as ES2 Chairman. Mrs. Praveena is the head of Data Governance Council at Circle, responsible for implementation, data management, and protection. And she also has done extensive work towards financial inclusion, especially women empowerment in rural areas through SHGs. Now, I would request Mrs. Praveena ma'am to address us with the words of wisdom.
Good evening, ladies and gentlemen. At the onset, I would like to thank IIM Amritsar and the director, Dr. Nagarajan Murthy, and Dr. Udayan Sharma for inviting me to their 5th Finance and Marketing Conclave Pariprekshya'. The word Pariprekshya' itself means perspective or paradigm. And today, I'm going to touch upon and give my perspective on the paradigm shift which has stemmed from COVID-19 in every sphere of our lives. Especially, I'm going to focus on rebuilding and expanding M&A deals in the post-pandemic world. See, mergers and acquisitions, we all understand that has been part of human civilization. And why do we do mergers and acquisitions? It is mainly done to expand one's sphere of influence with the view that it will bring success, sustainability, and ultimately we will achieve some prosperity, which is a byproduct of that. That is understood like that. Whether it's empires or it's corporates or if it's small businesses, all consider M&A as a viable route to growth. Because, see, this is a way where you can fast track the growth of an organization by adding complementary businesses to their value chains, such as backward, forward vendors, establishments, or sales and operations of competitors that you acquire. Sometimes even divestment is done of non-profitable SPUs, or your subsidiary or line of business, which were of very immense value to us at one particular time, but maybe now at this point of time, where the company doesn't need it so much, but there is somebody else who needs it, so they go ahead and they sell it in the market, and it can be taken over by somebody else. So that acquisition is by somebody else, but one company is certainly divesting it. So that may also be the right path. So this is about mergers and acquisition in a nutshell. And as M&A deals are inorganic way of growing, it was considered earlier very risky. It came into high risk. It was a high risk option to drive growth. So M&A teams were very, very meticulous. They took a lot of time in conceptualizing, executing, and executed it in a longer time frame. It wasn't done in a hurry. So because the focus was getting it right later, then getting it done sooner. If you look at near past, it is evident, 2018-19 was a time which is said to be the best year for M&A deals globally and also in India. They went up substantially. In some cases, they were multifold. Especially the sectors globally, which went ahead and did a lot of mergers and acquisitions, was technology sector, healthcare, services, retail, and food and beverages sector. But when it comes to India, we also saw healthy growth, but the sectors were different except for one, that is technology. And the other sectors were real estate, financial services, energy, and manufacturing. After 2020, we all know what happened. Breakout of pandemic, the whole world has changed. And we all know that the world has never been the same again. All businesses, M&A deals were also severely impacted, especially in Q1 and Q2 of 2020. Because the whole world itself stopped, so the deals also had to stop. But Q3 saw little movement, and that was, some of the deals which were in pipeline or someone who was in hurry to, expand for whatever reason. Those were the deals which started happening. But now where we are standing today, we are as good as pre-pandemic era, especially the areas which are now, or the sectors where the many deals are happening, at least in India or all the world also, have changed, of course, excepting one, that is technology. But now it's media, telecommunication, healthcare, online services, and also online education. So during pandemic, companies which were able to integrate technology into their product and services, they did very well, even during pandemic. And the ones which lacked these capabilities, they recognized the importance of acquiring one. So they scouted for the right targets to execute the deals, thought outright acquisition and, through joint ventures or strategic alliances, whichever way they could. To share like an example, I just tell that the US retailer, a Target Corporation, it acquired last mile delivery services startup called Deliv. And this was driven only by a single, single thought that I should be able to deliver my goods to the last mile, that is to consumer. So M&A deals in recent times have been announced by companies which are in the process of optimizing cost and unlocking value by capturing revenue synergies from such mergers. Earlier, the deals which happened, it was basically for cost synergies. And now that paradigm shift has taken place. Now, after post-pandemic, most of the deals are happening for revenue synergies. Because, earlier we all talked about bottom line, bottom line, bottom line. But now top line has become important, because ultimately when there is top line, then bottom line will go up. So, for example, the proposed merger, which has happened between Canadian National Railway and Kansas City Southern. If you see that these two have come together to create a freight rail network linking 3 countries, US, Mexico, and Canada, all in the same area continent. And the deal value, can anybody guess? It's as large as 30 billion US dollars. So you can imagine that what kind of deals are now in the offing. The trend of a strategic tie-up is expected to continue. This trend is going to continue in near future also. However, the large corporates, they are better placed than the smaller ones. One reason is that they have deeper pockets and the small enterprises are not so well capitalized. So earlier, deals were mostly driven, as I said, because of cost of, they were looking for cost efficiencies, but now they are also driven by new capabilities. And what are the reason why they want to do the M&A deals? To meet competition, fierce competition is there, broader regulatory issues, then managing risk, managing people, because now due to work from home, earlier when mergers and acquisition happened, the HR there will be a lot of activity. HR will try and integrate people. They'll have a lot of activities where people from both the organization come together, they understand each other, and then they go forward. But now it has become very difficult to do that. In the virtual world where people are working from home, it has become so difficult. And that is why all these now M&A deals have even become more complex. The new kind of risks have come, new kind of challenges has come. So there are instances where you find that some company are acquiring and divesting simultaneously. There is a very good example of Sanofi, which divested 5 billion worth of its minorities equity stake in Regeneron. And on the other hand, what it did, because that time when they divested, it was seen that, or it was expected, or this is what they said, that we are going to, grow businesses, we are going to do innovation, and we're going to reposition ourselves, we'll have strategies put in place. But just 3 months down the line, they announced a $3.7 billion of acquisition of US-based another biotech company, Principia Biopharma. So, this is suddenly the world has changed, and they have not stopped it here. They are buying few more companies like Translate Bio, Cadman, and others. So suddenly the need for growing inorganically has gone up. So what does that show us? That shows us that M&A deals are going to be the order of the day for growth for the companies. And when we see this new world, so the major changes which are going to drive M&A are, firstly, what has happened after COVID-19 that has accelerated disruptive trends across industries and has provided companies with a clear view of business model. Earlier, when M&A deals were happening, what happened, the people the teams which used to do, and even the business houses who wanted, they would create models, and they were not very clear what they really wanted. They will also go, for innovative things, or they would also suppose that this may happen in future, and then we should do it right now. but not now. With this pandemic, the world has become small in the sense that your horizon has changed. It's not very, very long view. You feel, okay, you know that this present position may last 2 years, 3 years, 4 years. What am I going to do in that? These are my options. So suddenly your business models have become very clear. What you want, you know what you want in future, and what you want to shed, which are outmoded. So those business lines you have to shed. So two things have become very, very common. And that's why the deal rationales have also evolved to give importance to expand the business scope and to add new capabilities. And what are those new capabilities? Number one, technology. Number two, proprietary data. And third is most important is talent, because talent is very scarce to find and everybody is scouting for the same people. So the number of capability deals have grown steadily in recent years, and especially if you see international market, so they're like Nestle. What did it do? They have huge outlets all over, and they have their franchisee and otherwise also. But they acquired freshly a healthy meal delivery system. Why? So that they could go to the last mile, B2C. The companies are now wanting to the whole value chain so that they don't have to depend on any second or third person to deliver their goods or company. So they are trying to acquire the complete chain. And this kind of acquisition was never in their radar before or anybody's radar because they were happy making what they were making. But now to deliver it to the consumer is also very, very important, or the client or customer. So the acquirers are betting on the value of bringing these capabilities in-house, not on potential cost synergies, which was earlier there. And here technology has become both an enabler of deals as well as source of opportunity and value creation. To make these deals successful, the acquirer need a tailored approach to screening, diligence, and integration. The second challenge which is there is bridging the valuation gap. As M&A process has become faster and more complex, while corporates acquirers have an advantage as they can create proprietary deal flow. They often face a stiffer competition from private equity. That's the new player which has come in this arena. And these are PE funds. In other words, every deal has now become an auction process. So many people are wanting the same deal. I want to acquire. So the PE funds are become one of the major players. And you know how much the kitty they are sitting on? $2.8 trillion. So they are like corporate acquirers, and now they are holding their assets much longer and use buy and build strategy. They buy, they build, and then over a period of time, they sell. So that's how, otherwise the exit route was always going IPO, and they were wanting to do it as soon as possible. But now that's they are also ready to wait. So these are the new entrant in this field. During pandemic and even now, see, access to debt capital was not an issue for large corporates because good quality assets command higher premium than ever. And the competition for the same is tough. So M&A may not be the best participation model. So what is happening? The M&A teams need to consider broader options of partnership. And sometimes it happens that the acquirer company may not have, because the target company may have many buyers or many acquirers. So there is a competition. So you may not have that kind of fund, though you have the debt capital is there, but then there is a limit to it. So at that time, there are different options M&A teams have to do. And what are those different options? And those different options are, first is partnership. You give them some equity with or without equity. You may go for joint ventures. And then, of course, corporate venture capital may support you, depending on the situation. Sometimes if acquirer doesn't have the funds demanded, then it may have to convince the seller to staggered payments or give equity. So these are the kind of things are available now for bridging the gap, which was earlier not so much needed because there was longer time, you could prepare well, but now everything has to be done in a jiffy. So the market is also changing accordingly, and M&A teams are also finding it very, very complex and tough to survive in these times. Finally, diligence. The third thing which is very, very important is diligence has become very challenging during pandemic, and closing deals have become more difficult because the new kind of risks have evolved. Like suddenly ESG compliance has become very important. Regulatory scrutiny has become very, very important, or they become very strict. Then when they talk of regulatory scrutiny, then deals, it is on national interest. Then comes human rights issues are coming in from right to privacy, non-discrimination. All these things are also bundled in that risk. For many acquirers, these are new territories which it has to navigate, which may not be there with such high importance. So companies that adapt quickly is developing capabilities in areas such as virtual diligence, virtual integration, and also they are made great strides in the toughest times, of COVID-19. The companies which have been able to master these virtual diligence, virtual integrations, they have done very good M&As even during COVID-19. The use of data in M&A process is another emerging, differentiator. Leaders of such companies, they are harnessing data and sometimes using artificial intelligence. And to what? So that they can screen a target company, create their profiles even before they are in the market. So this is how fast things are. So in today's scenario, even the most astute M&A teams are busy refreshing and rebuilding capabilities. And towards this, it is very imperative to get, number one, experts early. When you're going for M&A, experts have to be brought in early. Otherwise, what used to happen earlier, that you do your deal, you do everything, and in the end, when everything is ready, then you bring in experts, the sector experts, or the, whatever, supposing it's a risk, so you bring the risk expert, whatever, forex risk, whichever kind of risk is there, or, want to know about the product. So you will bring them later, and then they will give their advices, and accordingly you will take and things will go. But not now. Now the experts are brought in much early. So every field from business fit to due diligence. Therefore, virtual corroboration tools now are most essential than ever, much more. Because everything is being done virtually. You can't go anywhere. So how do you bring in? So you have to bring in virtually. So virtual collaboration tools are very, very necessary to get experts early. Second is, you have to know your turf and move fast, as competition is fierce for good assets. So establish an ecosystem of external partners for swift access to the appropriate data source. Data source you have to have, and connections and financing. Three things are important when you are going for M&A deals. So data source is a new thing. Connections, of course, were there, and financing was already there. So you must know your turf and move much faster on this. And these should be tied up. The ecosystem should be ready when you go for this. Third thing is due diligence with new perspective. Traditional values will remain. The traditional things, you have to do those kind of due diligence, which we're doing earlier also. But new dimensions such as culture, sustainability, consumer sentiments, ESG, should also be evaluated at the diligence stage itself. Next, which is very important, is, which I really believe in, that we must know divesting. Divesting is very, very important. Companies that move quickly and creatively to overcome these obstacles to divesting will outpace competitors because they will shed the asset which they do not need. It may be of use to somebody else. So you just put it on the market and it must divest. Then they bring in some value in form of cash, which can be utilized in acquiring something else, like Sanofi did. So these are the new ways of doing things. Then reevaluate M&A linked to strategy. Companies need to take a new approach on where to buy versus build to remain competitive in the years. What was happening earlier? Earlier, you remember when the new age banks came, old banks or the public sector banks, they all created their own technology. They took their own time, and they reached certain level. Maybe they are doing much better, in technology front as compared to their other peers. But they took so much time. But now, is there so much time? No. So it is, it is not the time when you build. It is the time you can buy. So it is better that the things you can buy, you buy and go ahead. And go for non-traditional methods. So most M&A practitioners expect to see more partnerships, joint ventures, corporate ventures, capital in the coming, corporate venture capital coming to their folds. This is the future. The whole financing part will be very different than what it used to be earlier. The industries where pandemic has hastened the disruption to their business model, for them, M&A will be more relevant than ever. And because the revenue synergies are more important now as compared to cost synergies. For example, like traditional media and retail will experience more consolidation because what was traditional media, newspaper, some news channels. Now everything, even if you have TV, now by and by in most of the foreign countries, people don't watch TV. Everybody is looking at their mobile for all news, and that's what we also do. So if any newspaper who is not on mobile on daily basis, so that is of no use. So that's why it is necessary that they get technology driven. And consolidate as the skills become increasingly important and you have to invest on digital. If you don't invest in digital, you do not survive. The competition is going to kill you. So in banking and telecommunication, so you see that this is being also encouraged by regulator. We have seen a lot of mergers in banking, which have been pushed by the government and regulator. Similarly, same thing is happening in telecommunication also. So BFSI sector, there are a lot of mergers are happening. So that is one of the very good example in India. Even if you see lately Byju's, which has taken Akash Institute, or why? Because they were complementary to each other. Here take people up to a certain level, and then this other person takes over. So why should it go? So they are making the full chain. The whole supply line is going to be with them. So that's how it is happening now. What I feel, when I look at COVID-19 pandemic, it has unleashed a process of Schumpeterian creative destruction. I'm sure you are all MBA students. You must have heard of it. It's that story when people were all. That's a theory by Schumpeter that said that earlier there was cars. The carts were being used, and then suddenly car was invented. And the people moved from carts to cars, so carts became useless. There was no need for horse carts or bullock carts, and people moved to mechanized vehicles. But then it created more jobs. It created a different kind of jobs, different kind of segment got something. So that is what COVID-19 has done to all of us. And no sector is untouched by it, because it's not only one mobility issue. It's all the sectors now it has been touched. So the dismantling of old structure and business model is opening up new growth opportunities. And we have to be prepared to take them on. And here M&A will play a big, big role. In order to thrive in this post-pandemic world, companies need to reinvent themselves. And they have a daunting task of navigating their core business with these major uncertainties and with staying alert to new growth and M&A opportunities. So they must also integrate these acquisitions and deliver return under these challenging conditions which have been, thrown up by COVID-19 to us. I also, when I look at everything, the whole spectrum, I feel the post-pandemic world, companies will be under a lot of pressure to demonstrate long-term benefits to their stakeholders for value creation. In addition to traditional M&A, a new range of inorganic growth strategy will have to be put in place, such as cross-sector alliance. You may be in one sector, but another sector you have to go for. Then co-investment with maybe private equity or venture investment in disruptive technology, and partnership with government may also happen. And all these will become very, very important in times to come. And one thing is very, very, very essential, I feel, for the leaders of the industry is to consider that ESG impact on their actions, ethical use of data in order to inspire trust across their stakeholders, such as shareholders, government, regulators, everybody who's a stakeholder. So that's something for the leadership to take care of. So in conclusion, I can say that future of M&A deals is very, very bright. The sheer volume of deals done this year indicate companies have already started using virtual and digital tools in the M&A process. The consistent use of predictive analytics, artificial intelligence, and automation technologies will help in providing deeper insights into business domains, identifying risk, and finding new synergy opportunities. Leaders need to pay attention to ensure that the cultural integration takes place in a perfect way and is handled very sensitively in the virtual environment. So with these words, I'd like to close and say a big thank you to IIM Amritsar for giving me this opportunity. It was a pleasure talking to you. And we'll meet not in virtual, but one-to-one. Thank you very much.
Definitely, ma'am. Thank you very much, ma'am, for enlightening us with your speech. And now, without further ado, I would like to steer the conclave towards discussion on the theme by introducing our honorable panelists. Mr. Sambasivan G, Chief Financial Officer, Tata Sky Limited. Mr. Sambasivan is a postgraduate from IIM Ahmedabad, a chartered accountant, a cost accountant, and a company secretary. He has over 28 years of experience across FMCG and service sector industries, including over 15 years with Vodafone at senior finance and operation positions. Mr. Vikas Ralhan, Chief Financial Officer, Lokanav. Mr. Vikas is a seasoned and result-oriented, sector-agnostic financial reader with 18 plus years of experience across industries and stages with technology, consumer, industry, media, and services, global and Indian startups. Mr. Ralhan is a fellow member of ICAI India, IIM Ahmedabad alumnus, and PGD holder in cyber and technology laws from Nalsar. Mr. Nitin Parekh, Chief Financial Officer, Cadila Healthcare Limited. Mr. Nitin Parekh serves as the Chief Financial Officer of Cadila Healthcare Limited, having an annual turnover of more than rupees 15,000 crores and has 36 years of post-qualification experience. He joined Cadila Healthcare Limited in February 2009 and has been handling the functions of finance, legal, and information technology. Before Cadila, he worked as an executive director of Ashima Limited. Mr. Venkatraman GS, Senior Vice President and Chief Financial Officer, Subex. Mr. Venkatraman GS is the Chief Financial Officer of Subex and has over 25 plus years of industry experience across all facets of the finance function. He has done his BCom honors and MBA in finance, has been instrumental in leading and completing the capital reduction of CBEX, which has helped in equity capital and balance sheet becoming leaner in line with the company size. Mr. Raghupati Mishra, Group Chief Financial Officer, Liberty House Group, India. Mr. Raghupati Mishra is dynamic and seasoned management professional with over 2 decades of experience and expertise in various aspects of business. He has a proven track record of turning companies to EBITDA positive, setting up new companies and putting in systems and procedures. His forte is fundraising, debt restructuring, formulating and executing business strategies, mergers and acquisitions. So now, the theme for the conclave is rebuilding and expanding M&A deals in the post-pandemic world. And the moderator will be Mr. Sambasivanji, sir. I request you, sir, to kindly commence the panel discussion.
So, good evening, everybody. So we had a stellar discussion or talk by the keynote speaker, Ms. Praveena Kala. And I really thank her for inculcating some of the thoughts, because a lot of, she had given a complete Pariprekshya'. So I thought that very wide perspective was given. So it will be a tough act to follow. So I'm also honored to be a moderator in this session, talking to 4 of my esteemed colleagues here, who have much more experience in M&A deals and having participated and having been the sutradhar of these deals. While I have spent a lot of time in telecom, I have the, the distinction of being acquired twice. Earlier, I was with BPL Mobile, which got acquired by Hutch. Subsequently, Hutchison SR was acquired by Vodafone. So I have seen merger and acquisition from the other side by being bought over. But here we have colleagues who can talk about buying and finding out ways of buying other companies. So let me start with the first question. So it will be a kind of a similar kind of questions I will ask to 4 of my colleagues. So I'll have about 4 questions. I'll start with the first one. Typically, every company has got a different way of acquiring another company, or a philosophy, what we call, of what a merger and acquisition should be for each and every company, each and every industry. So I'm sure each of our colleagues would have a different perspective. So my question is, how does a particular company design its M&A strategy? And also, there will always be changes in the design and the changes in the strategies. How and why those changes happen over a period of time? So this is my first question, and I would like to get perspectives from each of my colleagues. Let me start with Mr. Nitin. If you can start your perspective on this question, Mr. Nitin. Thank you.
Sure. First of all, thank you very much for this invitation by IIM Amritsar, Board of Management, professors and students. Happy to be part of this. Talking about this question, Samba, you talked about M&A strategy and why change, when change, etc. So first of all, M&A strategy is not a strategy in itself. I believe that it's a part of a larger corporate growth strategy. And as Praveena also mentioned, there are typically 3 drivers of growth strategy. What we call build, borrow, and buy. By build, we mean the organic growth. Borrow means typically joint ventures, alliances, and buy is what the acquisition is. And I have developed A, B, C, D, E, F of acquisition. This is an acronym. By A, I mean the access to inputs from markets, and inputs can be even the technology, assets, talent, onwards IP, many things, and markets, obviously the customers. B stands for business growth. C stands for consolidation. D is for diversification. E is for economies of scale or synergies, and F is for fiscal benefits or government benefits, tax benefits many times. Example, let's say Walmart's acquisition of Flipkart, is to get the market entry in the e-commerce market of India. But the Flipkart's own acquisition of Myntra is for consolidation. What Ajay Piramal Group has done in terms of acquisition of financial services company, real estate, startup is more in terms of diversification. Zydus Wellness acquisition of Heinz India is for business growth. So you can understand that these are all the real ones, right? Now coming on the strategy, strategy is dependent on what is the level of the organization in terms of size, scale, and therefore what are the objectives. For example, Zydus Cadila Group was formed somewhere in 1995 as a vertical split of Cadila Laboratories Limited. That time the turnover was 200 crore rupees. So the initial objective of M&A was in terms of reaching a reasonable size and scale, and also getting major, reputed therapies of various pharmaceutical products. Therefore, the first acquisition was done in 2001, which was German Remedies Limited. And that was the largest acquisition in Indian pharma at that time. Okay. And with that acquisition, we got the scale. We also got very good brands in various segments. Then in 2007, we acquired Liva Healthcare to get a major entry in terms of skincare market. In 2011, we acquired Biochem Pharmaceuticals, that is to get a major foothold in terms of acute segment. Then we went, to various other, parts of the world, like we acquired companies in France, Spain, Brazil, again to get access to the market. But when it came to US and Mexico, we had a different approach. We said that there is no need of acquisition because the backbone is in terms of manufacturing and cost leadership, which is in India. And therefore we can, depend on India, and we can start everything on a greenfield basis. Okay, so that was again on a build model. What I'm trying to say, the strategies are not necessarily same for all the markets. It all depends on you want to acquire for what. The moment you answer that question, you have the strategy. And Zydus Wellness Limited, in 2019, we acquired Heinz India Limited for 4,600 crore. Heinz has a very iconic brands like Glucon-D, Nycil, okay, Complan, these very iconic brands. And we also have, iconic brands like Sugar Free, for example, that is our brand, right? We have Nutralite, we have Everyouth. And we thought that, to get to the size and scale for Zydus Wellness in FMCG segment, we need to get good acquisition. Having done that, today, when we look at pharma and wellness, both, we are reasonable in terms of size. And now the strategy, therefore, is now different strategy. If I want to acquire anything in India pharma, it will not make sense because there will be a lot of product overlap. If I want to acquire anything in US, again, does not make sense because we are already a large player. We are $800 million company in US in generic. Okay, therefore, the strategy changes now. The way it now occurs is that our interest in US acquisition is in terms of specialty segment, where we now want to build new franchisee as a future growth engine. And when it comes to India, whether it is a pharma or FMCG, our interest will be in acquisition of only brands and not the companies. So that is the way, the strategy changes over a period of time. Thank you.
Very nice. Thank you. So you have very nicely put that you need to have a reason for acquiring a company. And once you have a reason, whether it is a geographic reason, whether it is a reason for scale, whether it is expanding a segment, whether it is future or cost savings, once you need to have a particular reason for an M&A strategy, and that keeps changing over a period of time. Fantastic. So let me get to Mr. Raghupati Mishra to get his perspective on the same topic. Yes, Raghupati.
Thank you so much, Sivan. I would like to thank the IIM Amritsar Coordination Committee and the students watching us and the professors there. And my esteemed fellow colleagues here at the panel. So today, basically, as the objective is to have a Pariprekshya', have a perspective onto the M&A part of it. Me and my colleagues here will try to get you a practical approach of how it is, because you people are much more knowledgeable than us in terms of theory. We will tell you what we exactly have done in the last few years in our career, and in terms of M&A, and what we have learned from there, and still learning from there. And we have failed, we have succeeded. So that's how we will try to get you into that kind of. Our group is called Liberty House Group. It's a group headquartered at London and present across 30 countries and in different segments. Why I am giving you the perspective, because how we have done the M&A deals, that will give you an idea. We are mostly into mineral trading, steel and aluminum manufacturing. We are one of the largest producer of steel in the world. And also financial services and green energy production. So During kind of January 2020, I was approached by a few people, which I know being in the industry and all, that we want to start the India story. So why don't you join us and start the India story here? So being the promoter, being an Indian, so the company has identified India as a growth story. That India should be there in their portfolio, which is not there. They're across various segments. So they want to first get into steel manufacturing here in India. So then I joined them, and we had a brainstorming session kind of in what to do in steel manufacturing. What are the facilities and all. So in M&A, if you see, basically, I'll come to this. M&A, as before Kala ma'am and Nitin had also told, that it's kind of a three things. Whether it is your organic or inorganic. In inorganic, either it is merger or acquisition, right? So basically, it comes down to the rate of growth of the organization. If your management is happy with your rate of growth that the company is going on, so it's a organic growth. If it is inorganic, then it is either you are acquiring somebody, as Kala ma'am told, that to get your sphere of influence enhanced. And merger is coming together of the resources of two or more companies, and then you, as a whole, you become more. That's merger and acquisition. But all of these are true, but the basic thing is that your management is basically, if it is they are going for M&A, they are not happy with the growth the organization is having organically. So they want to get into inorganic growth. For inorganic growth, you get into M&A. So after these things, we sat and then we strategize into, in the steel segment, there are also quite a few, which market we should be in. It's a kind of primary steel or secondary steel with advanced alloy products and all. Which kind of products that we'll be making, flat products, long products, all these round products, all these kinds of there. Which market we should be in? Should we be in the export market? From here we can source it to exports. Our different facilities are across continents. We can source it as this thing, or we can target the auto segment and all. So this is the kind of strategy we fit in, and then what size of acquisition that we will be making. So we finally dealt with this thing, that 0.5 million to 1.5 million kind of range per annum capacity kind of products, kind of assets that is there available in the market, that we should go for it. And that the strategy we made. And then it was given a chance, it was given kind of an task to me, that in 3 years time you have to get 5 million ton per annum capacity, and you have to raise, and then gradually you have to get them into EBITDA positive, kind of raise your debt, raise your this thing, tell us what we need to support them. So this was the kind of remit that was given. On that basis, we drove this, and we acquired 2.5 kind of products, and during COVID itself even. And the second wave came, and now we are again on the lookout for other acquisitions there, all brownfield acquisitions. So this is the way it works in terms of acquisitions in India, at least.
Thank you, Raghupati, for the very detailed answer in terms of your story on how you looked at a strategy and how you actually implemented for the steel industry. Can I then jump on to Mr. Venkat, who is from Subex, and he can give his perspective on how M&A works in his sphere of influence. Yes, Mr. Venkatraman.
Yeah, thanks, Samar, and thanks to IIM Amritsar and the student community and the professors for putting this event together. Very happy to be part of this interesting conversation. And I also like the name you put together for your event, right? Pariprekshya' is a very profound way of saying knowledge and how do you look to get different perspectives. So coming back to the point, as you know, see, Subex, I don't know how many of you know, is one of the few listed software product companies out of India. I think in India, there are a number of software services companies which are listed. Subex is one of the few listed software product companies that have been listed for a long time. And we are in the space primarily supporting telecom companies. Our software products are used by pretty much all the large telecom operators worldwide. Almost 75% of the telecom operators worldwide use our products. We are very critical and integral to their operations in terms of how they look at their revenue assurance, revenue leakage, fraud, and other aspects of the business. So that's just to give you a perspective of what Subex does. And just coming back to M&A and the strategies we adopt, I think as many of my other colleagues in the panel spoke about, companies look at M&A to either look at faster growth, faster access to specific markets, or gaps in your portfolios. I think that's something which I didn't hear as much, but I think people spoke about the first two more. So gaps in portfolio is also a reason why companies look to acquire, because sometimes if you were to build those portfolios yourself organically, the time to market can be longer, right? Because it could be a newer area where you want to expand, and it could be an adjacent area where you want to get into, which you want to get in quickly. And if you want to do that organically, it might take longer, and maybe the market may not necessarily wait for the company to build that on their own. So therefore, newer areas are also is one area of focus, and that's one of the reasons why we look at acquisitions as a means to do that. For example, Subex has been in the telecom space, and we support companies in that space, but we also realize that if we want to grow and grow faster, we also need to be able to address our solutions to adjacent verticals where need for certain type of solutions, let's say fraud management, because we are well known in the telecom space for fraud management. But the fraud management solutions which we offer lends itself very well to some of the other industries like online e-commerce or fintech or insurance companies, where equal and more number of frauds happen, and at very fast scale, and where volumes of data needs to be processed in real time. And this is what we do for telecom companies. So that was one of the areas we chose to say that we will look at companies which are addressing such solutions, and in, of course, markets where the opportunity to take these solutions to customers exist, and in terms of growth opportunities are also faster. So it was a combination of getting to look at companies which can give us adjacent areas where we can target, and also give us faster growth. That's one. And I think if you look at the core of our business and opportunities there the option was to say that, okay, there are certain markets where we are fairly strong, but there are certain markets we are not as strong, and we would want to expand our presence over there. And therefore, we will look at companies which are strong in certain regions and certain geographies, which we can then look to acquire, which will help the company get scale and a larger scale in those particular geographies. So a combination of these two factors is what I would call out as the reasons Subex looks at potential M&A opportunities.
Thank you. Thanks, Venkat. In fact, we have worked with you. I don't know whether you remember, 10 years back when I was in Vodafone, we did have Subex for our revenue assurance team.
Yeah.
Okay, so thanks for that gap in portfolio perspective. So let me jump on to Mr. Vikas to give his perspectives, last but not the least, on why we need a M&A strategy and how it evolves over a period of time.
Yeah, thank you, Samba. Hi, thank you, Samba, and good evening, everyone. The fun thing about being on the last in list, you left with only your client or your company specific conversations. But yes, the last 60 minutes are quite amazing, and trust me, I have taken good amount of notes. Despite I believe in, I am doing good in setting up M&A theme at my workplace. So for our workplace, the M&A starts from a very one bullet point, how to grow faster. So there are two ways, whether you build or you buy. When you start thinking of buying, then you need to think of what kind of a buy or what kind of M&A decision you need to take. It can be doing backward forward integration. It can be solving the talent acquisition via acqui-hire, or it can be just sitting on the IP side so that you can get into a new market, because in many markets, the customer rights, distribution rights are very vital for you to expand. So why my learnings or why my thoughts are slightly different from the other panelists, because I am part of the startup ecosystem where the hacks, fail fast, move forward is bread and butter and day in, day out theme of our behavior. And so do my nature also has changed. Despite so much learned at the institute, I'm also thinking more like a startup founder, where we become very impulsive. Second, the FOMO is part of our deal structure, fear of missing out. So if the right target is available, we never leave that target just for the right valuation strategy. Because if you acquire that target, you get the foot in the door, and so do the customer side. And how we do it, it's by the two methods very strongly. Either way, do the acqui-hire, because acqui-hire brings us the biggest benefit of having the talent, because we all are struggling with talent to grow and scale. And second, we prefer doing the backward integration to enhance the customer experience. Considering the chip shortage and the supply chain disruption across, doing backward integration for me in a fleet tech company is utmost important. And we have done small, not big size deals, but close to 7 deals in the last 12 months. And we are too much benefited, not only in terms of the customer experience, but also in terms of the evaluation. And VC love a lot once you start building on both sides.
So
fantastic. Thanks, Vikas. In fact, he brought in a completely new flavor to this perspective on how a startup looks at M&A and how you actually do 7 deals in a span of 12 months and still integrate. So now it's a nice segue to the next set of perspectives, because the moment you have a strategy, then you have to implement. So when you have to implement, you'll have to first think of how do you value a particular target? How do you negotiate? And most importantly, after negotiation, after implementation of the buying out or merger, how do you actually integrate with the new organization? So valuation, negotiation, and integration. To give the perspective, I would again request Mr. Nitin Parikh to give the perspective on these 3 words: valuation, negotiation, and integration. Thank you.
okay, let me speak in the same order. So valuation, when we are on the acquisition side, when we are the potential buyer, typically starts with the DCF method. So it's not only a book method, it's a real method. What is very important in the DCF method is what are the assumptions that you make. The method and the calculation are very easy, but the assumption in terms of the growth that you will take, assumption in terms of WACC you will take, terminal growth you will take, I think these are very, very important. And that is what differentiates the value which buyer A, is considering for DCF versus buyer B. And so DCF is not one answer, that's important for students to learn. Having said so, I, in my experience, can certainly vouch for that. Hardly any deals really happen at DCF value. Invariably, they happen at higher than DCF value. Okay. I don't know whether this DCF is calculated by finance, that is why it is happening in a lighter tone, but somehow the real deals happen at higher than the DCF value. What is important there is that beyond DCF value is something like a synergy. And that is again everybody's call. That what is the synergy, that benefit which you will be able to bring? As is basis, valuation of DCF is one thing, but when you bring the synergy element to that, the value enhances. And the real deal normally happens in terms of what part of the synergy gets actually shared or added to the DCF value. Okay, that's the way the general valuation is done. At the same time, this valuation gets compared in terms of cross-checking with the trading multiples. There's a revenue multiple and EBITDA multiple, other things. The startups, Vikas mentioned, obviously is a very different kind of multiples. Okay, there are different parameters in terms of growth and profitability in future, which bring valuation. Vikas gives a very good perspective, and students, I can certainly suggest to read more articles of Aswath Damodaram to understand startup valuation. Beyond that is obviously the auction process, which Praveena also mentioned. That auction process typically drives the valuation up. If there is a control premium concept also, that if you are not acquiring 100%, but you are acquiring majority stakes, giving you management rights or control rights, veto rights, what we call affirmative rights, matters. There, the value obviously is little more. One suggestion here, based on experience on valuation, as the last point I will say, is that prudence is important. Don't ever fall in love with the target. The moment you fall in love with the target, you say you need to acquire this, you will invariably end up paying high price. So we as Zydus take a pride that we have been actually pushed out of deal many times because our bid does not meet the requirements. Nothing wrong about that. Let me now talk about negotiation. Negotiation requires good preparation. It's not very easy, but still, important to find out why the sellers want to sell. And maybe there is something, which will give you in terms of the negotiation age, in terms of trying to understand. When you go for real negotiation, it makes a lot of sense in terms of do a role play prior to that, in terms of when you speak, what other party will speak, what will be your counter, where you will end. And somewhere you decide your drop down value. You say, okay, I don't want to go beyond that, even it means, losing the target. This preparation certainly helps, rather than doing this everything on the ground at the right point of time. Then some understanding of the commercial and legal aspects are very important in terms of negotiation. Very important clauses like, it's arbitration clause, indemnity clause, damages clause, net working capital adjustment, net debt adjustment. In fact, some of the investment bankers I have worked with, they tell that Nitin Parekh, you should take a class on calculus of net working capital for investment bankers. Okay, because that's the kind of deal. In last 12 years, I would have done more than 15, 16, both internal, external M&A transactions, including mergers, acquisitions, both sides, buy side, sell side. So, a lot of practical experience I now got because of that. And since I, apart from finance, handle legal, and I believe I'm reasonably good at that, I've been able to, do good legal negotiation also. What is important is also having some kind of fairness in this. While, you obviously want to protect your side and, put something which is in your interest, unreasonableness will never allow, negotiation to proceed. So there has to be some element of fairness. The agreements should be such, which are ultimately good agreements, because you may have to actually go back to the party. If you're a buyer, because there are indemnity clauses and certain other clauses, you need to go to sellers back, right? You cannot create the, agreements which are such that other party would never like to see your face again, right? That's not the interest. And the third one, integration. So integration is important for realizing the synergies or the benefits that you calculated. There are three important objectives. One is to first to preserve the core, then to integrate very effectively in a seamless manner, and third is to realize the savings or synergies which maybe cost, maybe capital. And the approach is, again, three types of approach. One is you take the best of both the organizations. Second is, which is normally fair, practice with many acquirers, is to believe that your own, style, parameters, policies are best, and therefore you impose that on the, acquired entity. And third is to create absolutely new now, because when the two organizations meet, the size and scale are much different. Maybe you need to think de novo completely in terms of what can be, the style of management, structure, and this works across, with the marketing, production, HR, finance. Your ERP systems may be different. When it comes to HR, your leave policy, your promotion policy, so many things, your, performance evaluation system, onwards, hierarchy, authority matrix, so many things will be different. So a lot of integration is required. And the culture is very important. If you fail in terms of cultural integration, the chances are that, this integration will fail, the merger will fail. And therefore, I give a lot of weight to that. Communication is very important. I think Vidya Balan gave us a very good mantra of Bollywood success: entertainment, entertainment, entertainment. I use this particular methodology of saying communicate, communicate, communicate. Thank you.
Excellent. Thanks, Nitin. Okay, so he's given a lot of nuggets of wisdom. Communicate, communicate, communicate. And you have to have some fairness. And you should do a role play. You should prepare well. And don't fall in love. The last but not the least, don't fall in love with the target. That's a very, very important philosophy which you should have. Let me go to Raghupati for his new perspectives on the same topic, VNI or VAN, whichever way. Yes, Raghupati.
Thank you, Samba, and thank you, Nitin, for that. I'll go by you, VNI, Samba.
Yes. Yes.
So, valuation, as we see, Nitin has already dwelled upon it. So, it will be not prudent to kind of replicate all those. All of them are quite right and all. What I have seen is that at the final, the valuation price, it's a feeling. Practically, this is how it is. नहीं यार इतने में ठीक लग रहा है यार, ये 500 करोड़ से ज्यादा मुझे नहीं ठीक लग रहा है. At the end of the day, with all your calculation, every method of the day, you know, whatever civilization understands the method you did, but lastly it's intuition. It's like the right price. This is the feeling that you get. That's it. That's how practically it happens. Even if whatever the nth till the cows come home, you do all your computation. That's how it happens.
Just sorry to interrupt you. There is always a concept called purchase price dissonance. After you purchase, you many times feel that you ended up paying price which you could have possibly reduced. I mean, there is no solution to that. But that is
this is like ladies going to buy clothes in a bargain market.
Absolutely.
Absolutely similar to that, right? So it's the feeling that this price is right, kind of it's looking like, it's a feeling that. Second thing in this, to add what Nitin has already told, that if you see, you have to go through with a fine comb at the various things. Look for hidden value. There are quite a few valuation. The things that you have not considered, and also hidden liabilities. Both the things. So getting hidden liabilities, go through every legal things, every notices you have received for the last 10 years. That's the least that you could do. So hidden liability need to be understood, hidden value. We have acquired one company, Adhonik Metallics Limited, and finally, when we saw that this is the price and this is, then I discovered I went through all their income tax return filings, etc., etc. We found out that the kind of carry forward losses and depreciation they have, I don't have to pay any taxes for the next 6-7 years. So basically, whatever the price, 100 rupees, if I am giving to acquire that 100 rupees I am getting from the benefit of tax. So I am getting the company for a song, for nil value. Only the time value I am paying. So then I went for it. I think I joined, and within 15 days we bid for it and we acquired it. I joined January, March 2nd, we acquired this kind. So that's kind of things that you have to see through this. Negotiation, as Nitin was saying, similar things. Here what happens is that you need to understand why somebody is selling it and who is the buyer. You need to meet them and understand what they are looking from this sale as you are acquiring, and develop a camaraderie with them. And I have seen this quite a few times, that even if some people were asking for better, were offering better value or better this thing, they had considered us to be kind of, or somebody else to be the right person to inherit their creation, which is going to the right hands. These were their words, kind of, by the promoters. ये बंदा अच्छा लगता है मुझे यार, इसको देना है, उससे बात करो, थोड़ा सा बढ़ा देगा, मैं बेटे से बात कर लेता हूँ. This is the kind of the father is saying कि मुझे बेचना इसी को है. Just because of the relationship he have developed in 2, 3, 4 meetings, the kind of things that they have told them, and the kind of strategy they have told that what they want to do. So the promoters generally in India, everybody is attached quite materially to their creations, right? It is not there in outside. In India, that is there. So they look to see that it is going to the right hand with the same kind of value in their minds. So you need to see that kind of. And the solution you need to give, that what is the solution? It is not the kind of right price only. It is the way how you are paying them, how that acquisition price is being repaid is also important. So thinking from the perspective of the seller, if you could give a win-win solution, and you can make this at the outside, you can say that, boss, if this deal is happening, that's fine. Otherwise, you will remain friends. It brings trust. So this is quite important, that the interpersonal skills that is required in terms of that, and your honest approach to buy is most important in these things. This has nothing to do with money. This is all human related kind of. So these two are important in terms of negotiation. Integration, I have seen in my this thing, and recently I have seen two companies in our field in steel industry. One is the acquisition of Bhushan Steel by Tata Group, Samba.
Yes.
The group. And the second is I was in SR Group for quite a few years. So SR Steel was acquired by ArcelorMittal.
Correct.
So how through IBC? All these two assets were through IBC only. So how these two happened, I have seen through all this. So from there, the basic 2-3 things are quite a few things are common. You have to go through that PPTO route: people, process, technology, and organization. That's a must. People are the most important things. What I have seen in all this, that the right person, the right management kind of who has acquired, they don't do anything for 6 months. They only do to know the asset, the people, the process, the technology, and the organization. For the first 6 months, they do nothing. They don't shift one night watchman even. All this, they only get to know all these 4 things in an organization. The next 6 months, they plan that how this could be better. They also don't touch for the next 6 months also. I'm giving 6 months kind of, this is not a gospel truth. I'm saying this kind of time frame kind of. So after 1 year, then they get into that, after assessing the people, where to deploy them more beneficially and all, then only they move changes. In SR Steel, the CEO is the same after 2 years. And it was a very bitter kind of acquisition that happened. It was a war that was out there. I was part of it, so no. So still the CEO is same after 2 years. So you can see the same thing with the Bhushan Steel also.
Correct.
Top management is the same after 2 years.
Sure, sure.
So this is the kind of thing. Don't just change people because you don't like their face, or they were kind of belong. They had worked with the previous management kind of thing. They are professionals. They are doing their best, and they will continue to do that. This trust has to come there.
Nice. In fact, there is a very famous statement from Ajay Piramal, who is a takeover tycoon kind of person. He said that I don't believe in sending my own people to acquired entity. Because those people in the acquired entities are also our people.
Correct. वही सेम चीज बता रहा हूँ मैं. अगर आपने people अगर सही कर लिया, उसके बाद process you will develop how to merge these two processes. People like Subex from Subex will do that. All the technology people, they will give you an answer. Just tell them, don't tell us technology, just give us solutions.
Very
because
nice.
That's how technology people are to be dealt with.
Yeah. Thanks, Raghu, for the really comprehensive and an elaborate answer. And I liked all your perspectives. You just moved away from the left brain thinking to right brain thinking, and building trust and emotion and the feel and the PPTO approach.
I hazard that even if I am a CFO.
Yeah. Yeah, no, that's a very important perspective to have. You need to have some kind of a right brain work when you are going in for these deals, but the feel and the relationship is much more important. I agree with you. So now let's get perspective from Venkat, and then let's go to Vikas. Yes, Venkat.
Yeah, thanks. So I think I will obviously not repeat. I think some of the points Nitin and Raghuti spoke were all relevant. I think one thing on valuation, I think as value is about what is in the eye of the beholder, right? I think you can do all your models. You can do your DCFs, you can do your multiples, you can do all your comparisons. And as Raghuti was rightly mentioning, it's about what you feel is the right price. And then finally, whether you're getting that value and will be able to realize that value over a period of time, because you will do your synergies, you will do what kind of combination the combined entities can bring is what you will look to do, and then arrive at the valuation. So I think it is obviously all of this and a little bit of that leap of faith you take on that number which you put on the table, which will decide whether the deal is on or not. So I think that's so I will not spend too much time on valuation. But I think on negotiation, I think as both Nitin and Raghuti spoke, I think if only one side wins in the process of negotiation, then you're not going to have a deal on the table, because you can never have a situation like that. I will do all the clauses, everything. It will be in my favor, and the seller has to agree. You're never going to have a deal on the table, because be that as it may, that the person wants to sell, it's not like it's a fire sale and they're desperate to sell, right? I'm sure they want to ensure that there's a fair deal on the table. So as long as you're ensuring, and you also consider those aspects when you're putting clauses and conditions, that it's a fair deal for both parties, you will always find negotiation processes are far more smoother. And of course, I think we used to have this joke in our company, right? It is due diligence. It should not become diligence is due, right? So as long as you ensure that its diligence is not due, I'm sure you will do a very good job of your negotiation process. Because if you don't do that well enough, and if you not spend enough time doing that, I'm sure there's always this. Yeah. So therefore, I think if and as Pravina ma'am spoke about, I think more and more deals today are competitive and multiple people are involved. So there's always this pressure to compress the diligence process and quickly complete it. And so therefore, if you compromise on that, then you may not unravel or discover issues, challenges which the company has got, which will lead to the negotiation also not being as good as it should be. And therefore, you could potentially have those purchase dissonance which Nitin was speaking about, right? Then you will discover and start getting into those kind of situations. The lastly on integration, I have a little different take on that one. I think it's not necessary, and I'm sure Vikas will speak about it as well, given his context. It's not necessary that every acquisition has to be integrated, because if some of these companies are very, very different and you're acquiring them for a very specific reason, for example, it's a new market area, new technology which you're getting in, you may not even have the expertise or the skill sets to run those companies or integrate it into a company whose rhythm and cycle are very, very different. So it's important also to recognize that early and say that to the target, saying that yes, we're going to acquire you, but you're going to continue running what you're doing. We're only going to help you, enable you grow faster or run your business more efficiently, but we're not going to get in and run the operations for you. So I think it's also important to identify which are those deals. Obviously, there'll be a bunch of them you will have to integrate, and the combined entities will give value. But there will be a few which will need to be run separately, and maybe at some logical point later on, as you acquire or as you get to the right point, you look to merge or integrate that with your other entities. But there will be few where you should run it separately, and that's where you will realize a lot more value. Samba?
Very nice. Thanks. Gave a completely different perspective on the integration element. I agree with you totally. I know of even in DTH industry where two brands one got acquired by another brand, but both the brands were continuing to operate in DTH industry as well. So let's go to Vikas and let's get the perspective on startups on how the valuation is done, because there's a 25 times, 30 times, 40 times, some kind of enormous unicornish valuations are happening there. So let's hear from Vikas.
Correct. I think we started the panel conversation from the left brain. Now I'm taking it to complete right brain side. We fell in love with Target a lot, and then FOMO creeps in our behavior. And then we start working and doing reverse engineering to arrive at valuation, justifying the valuation. Wow. And then closely working with the target team. Yes, this another market, this another product portfolio you can work with, because each one of us actually is building a unique product in the market. And there is no history of the market. There's a history of the solution. And we always play in a blue ocean. So had it been a red ocean kind of a situation, you can have all those left brain, the structured way of doing it. Once you get into blue ocean, where you're exploring markets, you're creating new product, you are solving a problem within a problem statement. So then you become actually more intuitive, gut feel driven when it comes to the valuation. And when it comes to the valuation, actually for us, negotiation comes first, then valuation. We negotiate first on the scheme of things, how it is going to fit into the my path to IPO, or probably my path to strategic buyouts, or to the global expansion. So it may sound slightly funny to all of us, but the vision we talk about, say 50 billion by 2025. That's kind of one vision statement we work. Then we start doing the reverse engineering, whether it comes by building the product or buying out some competitors. I'll give you one interesting example with not getting much into detail because it's a closed door conversation. Pre-COVID, there was a one entity which was competing with us. Post-COVID, we are going to bid for that entity now. So it was acquiring the good product, good market, foot in the door so that you can have a place allwhere. And then coming to the integration, yes, I largely agree with what Venkat said. Not all targets, not all opportunities can be integrated because of the cultural differences. It's not cultural fitment has to be there. Cultural differences are actually diversity. So we need to respect all those differentiation coming to the table because then your board will become inclusive. If you'll bring all fingers together, probably handshakes will go for toss. So the most important thing actually we work on whether all markets, all target acquired, making the whole proposition more conducive and more scaling. The sum of total parts, whether in terms of the leadership, the sum of total parts in terms of the entity we acquire is more important rather than putting a same color across all. We have presence in the Middle East. So we respect their Friday weekend, then the Sunday weekend. For us, this is a working day. So for me, the Sunday is also working day. But Friday, we do not call those guys. But it's not like we are pushing them, yes, start working on that Friday, but take a weekly off on Sunday. On the other side, you work with the Israel or probably in the Africa region, they have different holidays, different behaviors. And so do the people values are also very different. So the culture fitment is important, but not like aligning them, but just to respecting the diversity. If you respect the diversity, the 2 plus 2 will become 5.
Very nice. Thanks, Vikas. So Vikas brought out really the right brain side of things. And he says the uniqueness and the valuation are dependent. And it's for the uniqueness that you value and you negotiate first and then get to the valuation later. Very nice. And it's not a corny, it's unique and not corny, right? So fantastic. So let's, in the interest of time, I'll jump to the last question, what we discussed, which will be a kind of a rapid fire kind of question. We have got 9 more minutes to go. So I will start with Nitin and ask him to say 2 or 3 points relating to what makes a deal successful and what makes a deal a failure. So if you can just summarize in some 2-3 bullet points, each of you, then we'll be right in time for 7 o'clock.
So if the deal is first meeting your strategy, it's not acquisition for the sake of it. If meeting your strategy, the due diligence is done right, and then synergies are realized, or where required integration is done well, you are likely to succeed. The failures obviously have many more factors than success. Whether it's a planning oriented, at the planning stage, you have not done the right work. In due diligence, you have not done the right work. In terms of funding, you have not done right work. You have not negotiated properly or not integrated properly. I think at many different levels you can fail. What normally happens into the valuation part is that you overestimate many things in terms of synergy, in terms of growth rate, in terms of terminal growth rate, or you underestimate many things in terms of the cost increases, the hidden expenses, the hidden liabilities, which Raghupati mentioned, that you have not recognized the liability because due diligence was not done, or you did not recognize the need in terms of the capex, in terms of the maintenance capex or in terms of growth capex. You overestimated the capacity, surplus capacity available. Onwards, many things we have found such things happening in some of our deals also, and it's important for you to keep doing course correction and getting better equipped for the next day.
Yeah, a follow-up question, Nitin. Thanks for that. What do you think is the success rate or the failure rate of, say, deals such in M&A in general? And what has been your experience? Have you been more successful, or have you been which has been your experience in terms of?
We have been more successful than failure. We had one acquisition in Japan long back. It was a small acquisition, but where we went wrong there was in terms of our belief in terms of the generics penetration which will take place in Japan on the lines of USA. For example, USA pharmaceutical, the generics penetration is very high. Japan even today it is not so high because of the government policy where the patients get paid by the government, right, in terms of insurance or other thing, and therefore there is no incentive to really go for generics. They all still would like to go for innovator products.
Correct.
And there we then found that with the lower penetration, we are not able to get the size and scale in the time frame that we had in mind. So ultimately we close that unit. So that can happen. But larger acquisition like German remedies that we did, the Heinz that we have done, where the stakes are very high, we have done a wonderful job.
Fantastic, fantastic. Japan is a very tough market because I remember Vodafone also entered Japan and came back after some time. So, let me ask the same question with Raghupati with the right brain thinking. What are the things which you think that will make a deal successful and what makes it a failure?
Samba, I think your question to Nitin, I'll answer that because of the kind of group that we have. We have started this brownfield acquisition of plants from 2013, and now we are at 20 million ton per annum capacity steel producer in the world. And to give you a perspective, Tata Group has a 16 million capacity and JSW has 18 million capacity. So that's the perspective I am giving. So our history can say that we are successful in something around 85-90% of the cases. We have acquired all the mothballed plants, which the previous owners like ArcelorMittal or Tata, as we have acquired your assets from at Europe, and quite a few assets we have acquired these, and we have turned them around. Maybe 10-15% of these plants are still kind of not operational or not profitably operational. Otherwise, our success rate is quite high.
Fantastic, fantastic. Yeah.
So that's the kind of answer from our group perspective I can give in the steel sector that is there. And I think Nitin has covered mostly. We need to see the kind of the extra capex or opex that is required to get into a desired type of thing, and what is the market that is happening, that the market is going to behave in the next 2 to 3 years kind of, or 5 years kind of. And in terms of that, whether further capex is required or whether the kind of revenue you are expecting is going to come in that, these 2-3 things I think has to be, as a CFO, it's on our shoulder to get these things right. So that's the deliverable that we have the most in terms of this, and other things like people, process, etc. we have already discussed.
What at times also happens is that your understanding of the regulatory regime and the expected changes in regulation also makes a lot of difference. Like I remember Dr. Reddy's acquisition in Germany of Betapharm. After they acquired, there was a tender business with the government started. It means everything to be bought on tender basis, and obviously at very competitive prices compared to the branded prices that normally one gets. And therefore they had to take large impairment of that asset later on. So your study of how the things are likelihood, and there the government policies, how they are looking for the industry there you are. For example, we have pharma, and I would like to understand in new country where I'm going, what is government policy in terms of healthcare spend, whether they are talking of affordable or they are okay with high prices, what kind of price controls are there or likelihood of price controls being there. These are very, very important things. Everything comes in on a platter. You have to read many things, understand many things, talk to many people. You take the decision.
Fantastic, very nice. Venkat?
Yeah, so quickly, because as we're running short of time, I think obviously in our kind of business, it's people, and therefore the chemistry with the promoters and the company and what they are will make a big difference in terms of how these M&As work. In terms of why they don't work, I think one other different perspective I want to give. For example, you kind of get into a newer area or a newer technology because you don't have the capability, but sometimes the markets move and the markets move very rapidly. I think the Subex had an unfortunate example in the past where they acquired from a BSS, from a business BSS part, they went to the OSS part. That acquisition completely bombed because that particular area in the OSS space evolved so rapidly. By the time the company acquired, the market had moved, and they lost customers rapidly, and it didn't work in the company's favor. So sometimes being able to anticipate and look at some of those impending changes is also equally important, and that could be the reason why sometimes M&As fail. And just on the earlier question you had, Samba, I think worldwide data, I think what I remember some time back, it's less than 20% of M&As worldwide which work very well and are successful. So despite the amount of money and energy companies spend worldwide on M&A, the overall success rate is fairly low. But I think there are exceptions, and many companies get it right, as Nitin spoke or Raghupati spoke, in terms of some their acquisitions have been done well. And
We are
similarly,
Indians. We are Indians.
Yeah.
90% is unheard of. It's fantastic, actually. Yeah. Let's hear from the 7 acquisitions of Vikas, which you have done. You think all of them will be successful?
No, I would say slightly above than 50%, and the rest of them gave us the good amount of wisdom to do the fast deals. So whenever we don't do the good deal, actually we celebrate that more, because we got the great learning. Because for us, the time is an essence to move fast, and there can be various factors for your success. It can be good quality diligence. It can be the right price, synergies you are coming out. The failure factor, actually, you cannot anticipate where it will come from. I'll give you the 2 factors which I have experienced. One, we were doing acquihire, the key talent moved out. So I was going for that talent. That talent didn't have the proper agreement in place, and that talent joined a very big technology company for us. And that target went for bust. Second, which is the case study of public domain, where Zoom and Five9 were going to be merged, and all of a sudden, US government realized this is a national security issue. So a regulatory factor can actually derail your whole process. It can be in the technology, it can be pharma, defense, definitely. So the failure factors will come from where you cannot expect. Success you always can put on chart on table. So it's a mix for us, but I celebrate more the failure side, because that's a wisdom for me to move faster.
Wow. Fantastic. With that, I think we have come to the end of the session. I'll take a minute to summarize. So we started with talking about what makes the company, what's the philosophy of companies for going in for an M&A, the purpose for it, and how they evolve over time, what are the changes which happen in the strategies. From there, we moved on to subsequent topics on V&I, that is negotiation, valuation, negotiation, and integration. Lastly, we discussed specific case studies on how or why deals fail and deals succeed. So thank you very much. And we are, I think, thanks a lot, the panelists. I really enjoyed talking to you and getting your perspectives. There's a lot of wisdom, and I think more than 100 years of experience is there, which has given this kind of wisdom. So thank you all, and I am looking forward to the question and answer session. Thank you.
Our heartfelt thanks to our dignitaries for making the session truly knowledgeable for our students with their valuable insights. Now I would like to open the floor for questions. And the first question would be asked by Bhavya Dhanuka from MBA 07 batch.
Thanks, Jasdeep. And thanks to all the panelists for a really knowledgeable session on mergers and acquisition. So my question is, in the case of an acquisition, which one is more important among equity value and the enterprise value?
I guess that,
I guess both can be interpreted interchangeably, because enterprise value is the sum total of the asset price you're going to give. And when you talk about equity, you may narrow down the value, but when you see the larger picture or the 40,000 feet picture, both overlap with each other and can be used. But what question exactly you are looking for would be happy to answer, because this is slightly elementary one.
So speaking in the case of like a practical scenario, what from the perspective of an acquirer, what would be a more important thing to look at and consider?
So enterprise value, whether you arrived at by the left brain, the DCF and the structured method, and some premium over the fast acquisition, or you get in love with the target. But it's always about enterprise value, which you take certain portion or the certain stake in the cap table to get your positioning in the company.
Thank you, sir.
Yeah. Now the next question will be asked by Mr. Akash Kala.
Good evening, all the guests. It was really a great learning experience. Sir, with the pandemic, there are a lot of companies which are in vulnerable positions, and there are big companies, they are sitting with a lot of cash on their hand. And as just now sir said, like more than 70% of M&As fail worldwide. So should those companies go for M&A, or should they learn from the past and try to build it by themselves?
So when it comes to units which are under distress or difficulty, either because of leverage or losses or another thing, First of all, there is no pressure for sellers to sell unless it comes because the financial institutions, banks, or IBC process where they're compelled to exit, right? So sellers may obviously wait for the right time rather than being victim of somebody who has a lot of money and therefore wants to buy. You don't have to necessarily sell unless you are forced to sell, and you can wait for that. Having said so, obviously there are people with deep pockets who want to grow and therefore they would like to pay a price. Question is that, are you seller at a particular price? You can wait till that price.
And just to add, I think, Akash, it's about, see, the acquirer, when they're deciding to spend a certain amount of money to acquire a company, in their wisdom, they are thinking that it is going to be a successful acquisition. Nobody gets into an acquisition saying that it is going to fail. What I shared as data point is how it evolves over a period of time. So every acquirer, when they look at a company, their objective is to say that this is going to add value and therefore I'll make it work. So it's a combination of factors, some within the control of the company, some within, evolving, some regulatory, many of these things which lead to those failures. So just by the fact that if you start looking at the data, then M&A as an instrument for growth and rapid access to market will never happen. So I think while that is data, I think it's about what is your objectives and what is required and what will drive those actions.
So to add to what Akash, basically what they're saying is that failure is a part of life. Despite the best of the wisdom, there might be chances that you might fail. That's a very common thing to happen. It will go on happening and the things will move on like this.
Thank you, sir.
There are only very few differences between marriage and merger.
That's a very good point, Nitin. In fact, I wanted to start the meeting with marriage and merger, but I said it may be too strong to start with, and now you have come with the same thought. Very nice.
All married people come to that the same conclusion.
Yeah. In fact, my initial thought was to start with marriage and then talk about merger. But anyway, fine, good. Just come now.
So Akash, now you have to decide whether to marry or not.
Next question will be asked by Mr. Satveer Singh.
Hello, sir. Good evening to all the panelists. Sir, thank you so much for the insightful discussion. Sir, my question is regarding special purpose acquisition companies. So what do you see the future of SPACs in India and how our regulators are dealing, approaching to deal with this?
I can take a stab at it, maybe others can
Sure.
join. I think there is SEBI has come out with an approach paper where they're looking to come up with a similar model like what it exists abroad in terms of SPACs, where as you know, I hope you understand how it works outside, right? I think these are companies which raise funds without a specific business model in place, but just they call out that these are the areas they will typically look to acquire. So it works well for companies which want to go public. So they the SPAC uses, and recently I think WeWork did this in the US, right? I think they merged into a SPAC and then they were able to list very quickly. So it helps in faster listing for companies abroad. In India, I think it's still early stages. I think it will take some more time before it becomes mainstream. The fact that I think now you have the Zomatos of the world getting listed in India with the fact that they've got huge losses is the first step. I think it will get there. In my mind, it might take longer, but I'm sure there are other panel members who have more insights on it.
No, I agree with Venkat. It will take a long amount of time because India, we are still debating whether the organic way of reaching the capital market is more fruitful than actually taking the back door, because this is a backdoor entry for a capital market where someone is waiting for you at the doorstep and extending hand, just get into the market. So there are upsides, there are downsides, but so far India market is concerned, Indian regulator is slightly conservative than the US regulator. So do any new fresh approach will take time. And if you see last 3-month pattern of SPACs performance in US, it is not going to up to the mark. And the SPACs are not doing that good, except the biggies like Galactic International or WeWork, or there are a few EV manufacturer also has taken that route. else SPAC has their own downsides. India is always see the learnings, then take their wisdom and create a very curated products for the Indian market, because India regulation is slightly conservative. But yes, it will take at least 24 months to have something around this.
Yeah, I agree with Venkat and Vikas that it is going to take time for us to have SPACs, more prevalent in Indian market with the conservatism that SEBI would certainly like to have and other regulators. Having said so, I think the first set of companies which normally would go for SPACs would be for technology companies, startups, and other things, rather than the traditional companies.
Correct.
Thank you, sir.
Now the next question would be asked by Mr. Himakaran Kadali.
Good evening, panelists. So my question is are mass mergers the only way to survive the pandemic for small scale businesses, or like do they have any other way as well? Like, was merger the only way for small businesses to survive?
Samba, could you take that?
Yeah. So it's not necessary that merger is the only solution. So today, if you look at it during the COVID situation, there was another question which said that people are flush with cash, for example. So today, I think debt is available cheaper than ever. So if you want to survive, there are avenues by which you can raise funds. Raising funds, I think, is one of the ways where you don't need to get merged. But at the same time, if you have got a business model which can anticipate a good growth in future, while there is a negativity right now because of the economy not doing well, there could be some small businesses which they find it difficult. But if you have a business model which is viable for future, for short-term purposes, you can definitely get some borrowings, and for the right kind of cost, you can get the funds today, because I think many of the banks are flush with funds, and as you know, the government is also keen that they need to deploy funds. It's a different matter that these funds chase only companies which don't need funds, unfortunately. But yeah, I remember a lot of companies asking me whether we need more funds. But yes, it is not the only what you can say destination. Merger is not the only destination to summarize. Yeah. Yes, Hema.
Thank you, sir.
Anybody wants to add, please? Or a different point of view?
No, you are right. But
I think in addition,
don't think that
apart from banks, go ahead, Nitin.
Go ahead, Nitin.
So it's possible that one can still survive even if there is a temporary problem due to pandemic, because even the banks and the government has recognized the need, and there is going to be little slow process or softer stand will be taken by the bankers during this pandemic. And then it is expected the business will be back to its normal, and therefore even the profitability should come to normal. There's no need or pressure just because of pandemic for somebody to sell.
Thank you.
Yeah, and just to add, I think it's not just banks alone who give funds, and for smaller businesses, there are a number of funds, VC funds, who focus only on debt. They don't necessarily come into the cap table. They are happy to lend to companies based on cash flow. So if you have a reasonable cash flow model and the business is otherwise inherently good, there are companies there are VC funds which are willing to do debt funding. So there is enough opportunity. So it doesn't have to be a gloom and doom scenario of that.
There are structured products available, which have sort of quasi-equity, quasi-debt kind of instruments are available, to fund period which are longer than even the bank loans period. And what happens in such cases is that normally all the normal norms that we talk about in terms of interest coverage ratio, DSCR, etc., none of these ratios are considered.
I think to add what Venkat said, there are a number of venture debts who extend a good amount of liquidity. And we all be surprised to know what kind of criteria they follow. They follow the certainty in cash flow and the quality of management team. There are two criteria they follow.
Yeah, look at the founders, promoters, owners.
Because for them actually is a good amount of rate of return coming to their venture debt which they're extending. And when I started my startup career back in 2012, there were only 1 or 2 funds. Now I can remember it's close to more than 20 venture debt funds. Some are as big as multi-billion-dollar venture debt funds are operated in India.
Right.
The next question would be asked by Mr. Kunal Bhotekar.
Hello there. I would just like to say a very big thank you and a good evening to all the panelists present there. My question is that mergers and acquisitions have always been time when investor trust in organization has been under question. So has this pandemic added any element or any more angle to this question, or how you can retain or maintain the trust of stakeholders?
I think the premise is wrong, Kunal, sorry. I don't think that investor trust and M&A has to do with each other. There may be, say, 5% of the cases where there could be a reason of investor trust, but I think in 90% of the cases I have seen, at least wherever I have worked, typically what happens is that the management decides, or the leadership team decides what do you want to do, and they go and propose to the board, and they go and propose to the shareholders, and typically that's how M&A deals happen in many of the cases. It is not that suddenly or when it's a promoter-run company, it's the same person, right? So it's not a problem. So the investor trust, I'm not sure whether it has got any linkage with M&A. I don't know. I want to get perspective from others also.
Yeah, so I think see, it is not either or, right? I think the M&A is a means for the company to grow, and it is very articulated strategy. And if you're a listed company, you will go explain to your shareholders why you're doing it, and therefore then they will either buy into a story and then decide they will vote in favor or against. And of course, most companies have got reasonable promoter stakes, so they will be able to put their weight behind it in terms of why they're doing it and what is the reason. So to attribute trust or lack of it because of M&A, I think is a little flawed in that sense, as someone rightly put it. So I think these are two tracks by themselves. I think lack of investor trust because of the way the management of the company is done, or some practices or government practices the companies adopted, could be a different problem which needs to be solved anyway. So these are not necessarily interlinkable in any form, in my view.
So I actually echo with what Venkat said. When investor lacking trust, then they may push up for the M&A, or they can put your entity for some sort of the unpleasant buyouts or structuring. Else it has to be the internal motivation for the core team or management or a business team to look out for, because it cannot be external factor driven transaction.
The next question will be asked by Mr. Amar Dhoot.
Hello. Good evening to all the panelists. Sir, in recent time, merger and acquisition deals have been accelerated. This merger and acquisition may lead to market monopoly or duopoly, and it will create entry barrier for startups. So how this acceleration in merger and acquisition deals will impact startups?
So Amar, first of all, there is a body called CCI in the country, okay, which is a different form of MRTP Act, which was in 1959. So CCI ensures that there is enough of competition which is going to remain after merger. So there are thresholds, there are guidelines which are said, assets, turnover, various other things at entity level, at a group level, which ensures that there is not going to be lack of competition which can lead to that kind of situation. And having said so, if there are mergers and acquisitions happening, I don't directly see any connect in terms of startups, because startups all come with their very unique ideas, and which has some utility, some market, and that's why the startups can actually come up and grow.
I think I agree with what Nitin said. CCI is the finest body India have, which will evaluate large ticket deals. When it comes to the small buyouts, they will be least bothered because you are not going to disrupt the equilibrium of the market. And I think one can see the parallel learnings coming from China, where there was a disequilibrium. The state stepped into the market and now disintegrated the monopoly created by few tech biggies. So,
and add to what Vikas is saying, see, all monopoly and duopoly are not bad. If a startup has come up with the best chole bhature have 60% of the market share. CCI has nothing to do with that.
Unless until you become an anti-customer, no one is bothered because if you are customer focused,
restrictive trade practices etc. are there under that. If that doesn't come into play, then अगर कोई छोले भटूरे बेच रहा है 60% मार्केट शेयर है, किसी को क्या दिक्कत हो सकती है? It's like that. You have to understand that. So I don't think there are regulatory mechanism in place. I don't think there is a fear.
By the way, customer is the biggest regulator, the way.
Yeah.
So it's open market.
It's open market. So I don't think, in today's world, getting a monopoly is very, very difficult. It's
but
getting
incidentally, Raghupati, are you starting any new startup with Chole Bhature or what?
Bada Pav.
Bada Pav, okay. You can consider as financiers for that.
Yeah.
So I think Mr. Mishra, you should start as a SaaS model so that we can subscribe that Vada Pav coming every day to us.
As I am at Mumbai, I'll start with Vada Pav.
Vada Pav is a good idea.
The next question would be asked by Mr. Rishikesh Kothavade.
Good evening to all the panelists. It was indeed a pleasure learning from you all. My question was, how does any company decide if they can go for M&A deals or not, looking at the COVID situation?
I guess this point has been answered. Nitin, please go ahead.
This is how we started. This is how we started meeting, I suppose. Maybe you joined a little late.
Yeah.
So first of all, whether you want to go for M&A deal or not, is a function of your own growth strategy. And then whether you can go ahead with this or not will also depend your resources, your capabilities, the value required, whether you can fund that, whether you can manage that, and whether you can ultimately realize the objective that which you are setting for yourself.
Okay, sir. Thank you.
The next question will be asked by Mr. Drumil Mair.
Everyone. Actually, it was such a knowledgeable session for us. We came to know many aspects of M&A and its success and failures.
Volume is not audible. Sorry, it's I don't know whether it's for me or for rest of you.
No, it was not audible.
It is a little low. I think.
Audible now?
Speak up.
No, not really audible as yet. Maybe some speaker issue.
Yeah.
It's better.
Yeah.
Am I audible now?
Be a little louder.
Am I audible now?
Yeah. Good.
Okay, sir. It was such a knowledgeable session for us. We came to know many aspects of M&A. My question was like, there is an increase in M&A because of COVID situation. So is there any negative effect on market because of it or not?
First of all, I don't think there is an increase in M&A during COVID time. In fact, COVID time saw little slowdown in terms of M&A activities, more so because most organizations who obviously have cash and power to acquire also, they went slow and with a cautious approach to conserve the liquidity, thinking that there is uncertainty till what time pandemic can last and what can be the ultimate impact on their business. So most of the players, while they had a liquidity, they actually went slow on that, except private equity people.
Session here, and a heartfelt gratitude to the panel for answering all the questions for the students of IIM Amritsar. And now Ankit will be presenting a video prepared by the media and PR cell of IIM Amritsar. And the video will be introducing to you all the campus and what all happenings go around here.
Sure.
Is it visible, Jasdeep?
Yes, Ankit, it's visible.
Yes.
The audio is okay, right?
No, the audio is not coming.
I'll just check.
It's coming now, Ankit.
Okay.
Thank you very much, the media and PR cell of I Am Amritsar, for that amazing video. So now I would like to hand over to Miss Gunjan Preet for the vote of thanks.
Thank you so much, Jasdeep. Respected guests, faculty members, CNBC team, and my dear friends, a very good evening to all. It's an honor for me to propose a vote of thanks on behalf of the Indian Institute of Management, Amritsar. We would like to extend our heartfelt thanks to Professor Santosh Tiwari and Professor Chetan Chitre for guiding the industry interaction cell. I propose a hearty vote of thanks to our keynote speaker and to all the panelists for gracing this event with their presence. We believe that this will act as a foundation stone for future collaborations. Thank you all for enlightening us with your knowledge and experience. I'm sure the students will benefit from this discussion and will reflect upon this. Furthermore, I thank our exclusive media partner, CNBC, for covering this event. We all are very grateful to the sponsoring organizations and the media members. I want to extend our gratitude towards the IT team for the smooth functioning for today's event. This event would not have been a resounding success without the seamless efforts of media and PR cell of IIM Amritsar. We also extend our gratitude to Team FEC, the Finance Club for setting relevant context for the event. Last but not the least, I thank the students of MBA 06, MBA 07, MBA HR 01, MBA BA 01, EMBA, PhD 01, PhD 02, EPDA, and our alumni for their constant support, patience, and engagement. Without you all, this event would not be possible. Once again, thank you so much.
Thank you all.